Everything is cheap. I just did this recently, and if you price food or real estate in gold, it's cheap.
Yep.
I went back to 2005. That was where someone had asked me, the person actually had put away $10,000 in a hurricane fund in case something ever happened. And it was in 2005. So we started looking. In 2005, the average price of a house was $240,000 or $50,000, if I remember right. And gold was $425 an ounce. So, let me just do the math here. Hang on a second, and I'll prove my point. So if you take 225, let's call it $250,000. It was a little less than that, but call it 250 and divide it today, back then by $450. Well, that works out to 555 ounces. So today, the price of that house, to your point, did go higher in dollar terms. Now it's 420,000. So it's up almost 200,000. So it appreciated against your dollar. We're seeing the central banks continue to buy gold at a fever pace. The second quarter number was 166 tons that we saw. We're seeing things like the China mandate, where they're now mandating insurance companies. The insurance regulator in China requires 1% of assets in physical gold, but funded by the selling of U.S. treasuries. And at current prices, this will absorb, as they expand this program, as much as 20% of annual global mine supply. The thing that's interesting about the Chinese is that they only allow physical gold. They don't allow paper substitutes. We see the continued amount of deliveries off of COMEX. Last I looked, which was a few days ago, we had just shy of 30,000 gold contracts delivered and just shy of 2,000 silver contracts delivered. Since July 31st, we've had over 91 tons of gold stand for delivery. That's since July 31st, right? And about 270 tons of silver stood for delivery in August. And so year to date, you're getting close to 900 tons of gold that have stood for delivery. This is insane. The first 3 days of the August contract, we had 20,165 contracts post. Now, most contracts in my career either were rolled over or cash settled. Less than 1% stood for delivery. Those 20,165 contracts representing over 2 million ounces of gold, 100% of those contracts stood for delivery, 100%. So there's a big rush to accumulate physical metal, not just around the world, as we've documented for quite some time, you and I, but also at home. And this is what is very unusual about what's happening at the COMEX, is that some entity has gotten into Trump's ears, I believe, and all of the metal coming back is insane.
Traditionally, futures contracts for gold and silver were rarely fulfilled with actual delivery. Most were settled in cash. But in 2025, something unusual is happening. On the COMEX exchange, nearly all recent gold contracts have stood for delivery, representing millions of ounces. Since July, more than 90 tons of gold and 270 tons of silver have been requested for physical handover. This marks a dramatic departure from historical norms. Large buyers are clearly signaling they want the real thing in hand, not promises on paper. It suggests mounting concerns about financial stability and a possible loss of confidence in the dollar.
Way different than anything that I have ever seen. Interesting that we have historically low money velocity right now. At the same time, M2 is expanding. So you have an increasing money supply with decreasing activity. The money is not moving. And so it's pushing on a string. But at the same time, we see almost 500,000 jobs that have been revised downward. 461,000 jobs have been revised out of the BLS. It should just be called the bullshit BS, but it's Bureau of Labor Statistics. They've taken 461,000 jobs, revised them out since the beginning of the year. So every single one of the months where we get these record employment numbers and the stock market goes up and the metals market goes down, it's all been bullshit. Where literally, if you take 8 months, which we haven't even got the August numbers yet, so take 7 months and divide it into 461, what do you get? over 40,000 plus jobs, actually more than that, I'm sorry, would be, I don't know, 7 into 461,000. Let's just do the math. You got a calculator? Do the math for
Yeah.
me. So, what is it, 90,000 jobs or whatever a month? It's crazy that have, or 70,000 jobs a month almost, right?
About there, yeah.
70, yeah, that have been revised out. And so all of these jobs, all of these wonderful numbers, it's fugazi. And half of the jobs that they're reporting are part-time jobs, people working 2, 3 jobs to make ends meet. Why do I say that? Because the Fed is talking about cutting rates, right? It's likely that they're going to cut rates into the September meeting. Well, this is classic stagflation.
While headlines boast of strong employment numbers, a closer look tells another story. In recent revisions, the Bureau of Labor Statistics quietly erased more than 460,000 jobs from earlier reports. That means each month's growth was exaggerated by tens of thousands. Even worse, many of the remaining jobs are part-time or second jobs, not signs of prosperity. This discrepancy is critical because financial markets often rally on these reports, pushing metals down temporarily only for the revisions to reveal weakness later. The data exposes a troubling reality. The economy is slowing despite official claims of resilience.
You have the CPI, which is the CP lie, which is also issued from the BS, the bullshit labor statistics, has stayed above 2% for 53 straight months. And, you know, they're never going to get down to 2%. So what did we just find out? We find out that Powell is relinquishing the dual mandate. They're going to get rid of the dual mandate, meaning their dual mandate was in essence stable prices and full employment. And they came out and they said, yeah, well, we are going to no longer do the dual mandate. We're going to stop striving for a 2% inflation, average inflation rate over time. And the new framework, we're gonna focus more on employment shortfalls. And so they're talking about the unemployment problem. Well, yeah, supposedly the numbers were so great until they revised 500,000 jobs out so far. And so what we're witnessing is lower rates, which will lead to higher inflation in an environment where no money velocity. So M2 is increasing, the money's getting thrown into the system, but it's not moving. And record low money velocity in a slowing economy facing massive layoffs and unemployment problems. So you have the setup for stagflation. And when you talk about what this really means, to me, this is, in essence, you know, he talks about wanting to help the lower income folks and, you know, buy a house and that kind of stuff. But wasn't it the low interest rates that got us in this problem to begin with?
Yes.
And so that's right. And the Cantillon effect, which we've talked about before, says the people closest to the money who have assets, they're the ones that are benefiting disproportionately from this increase in the money supply and from the lower rates, because it benefits the top 1%. Their asset prices will remain inflated. This locks out the average person from buying homes and investments.
The Federal Reserve is caught in a trap. Money supply M2 is still expanding, but the velocity of money, how fast it circulates, is at record lows. Inflation has remained above target for over 4 years straight, yet economic activity is stagnant. Recently, the Fed dropped its long-held dual mandate of stable prices and full employment, now focusing mainly on jobs. But with 500,000 phantom jobs erased and layoffs mounting, the picture is grim. If rates are cut into this weakness, inflation will accelerate. This is the classic formula for stagflation: rising prices, slowing growth, and widespread financial pain.
Everything is cheap. I just did this recently, and if you price food or real estate in gold, it's cheap.
Yep.
I went back to 2005. That was where someone had asked me, you know, the person actually had put away $10,000 in a hurricane fund in case something ever happened. And it was in 2005. So we started looking, In 2005, the average price of a house was $240,000 or $50,000, if I remember right, and gold was $425 an ounce. So, let me just do the math here. Hang on a second, and I'll prove my point. So if you take 225, let's call it $250,000. It was a little less than that, but call it 250 and divide it today, back then by 450 bucks. Well, that works out to 555 ounces. So today, the price of that house, to your point, did go higher in dollar terms. Now it's 420,000. So it's up almost 200,000. So it appreciated against your dollar. But that 555 ounces today, that has earned nothing but dust sitting, in a safe deposit box, is worth $1.859 million and buys you almost 5 houses. So the same thing is true. You go back as far as you want to go back, this will all play out the same way. And what you are witnessing is, and look at it just even this year, right? In a very short period of time. So far, year to date, let's take a look and see exactly so we can be correct on this. If we look at gold year to date, let's go back 1 year. So how do we do that? View charts and more. We'll go back 1 year. Let's go 1 year. 12 months. Okay. So gold was, what the heck is that?
You're going back 1 year from today?
Yeah. Gold was, what am I trying? I can't even, this is such
It looks like it was around $2,500, let's say.
Okay, so $2,500 a year ago today, and now it's at 33.90. So 33. My dog, you are driving me nuts, kid. 33.90 divided by 20 or minus 2,500 is so it's up $890, or in essence, I don't know, what's that up? It's about what, 40%? Is that right?
36%.
Okay. So, and the dollar's down 11% so far this year.
History shows gold consistently protects purchasing power. In 2005, the average U.S. home cost about $250,000, roughly 555 ounces of gold. Today, that same house costs $420,000, but 555 ounces now buy nearly 5 houses. In dollar terms, home prices appear higher. In gold terms, they've fallen. Over the past year alone, gold has surged more than 35%, while the U.S. dollar index has dropped over 10%. Holding wealth in dollars is a losing game, while gold preserves and multiplies real value. This widening gap explains why central banks, institutions, and even wealthy families are hoarding physical bullion.
So you're talking almost a net 50% swing in the value of your dollar if you hold your wealth in dollars. You are destined, in my opinion, destined to go broke if you hold your assets in dollars, your wealth in dollars. And this is why the rich get richer and the poor get poorer. You can go back as far as you want, or now that it's accelerating, look at it as far as 8 months ago. In 8 months, it's a 50% swing in just simply holding your assets in dollars, because it is being inflated away. And this is the path that they have chosen. When there is no coincidence, Jared, that when the vacancy opened up at the Federal Reserve, that Stephen Mirren was appointed in there as a stopgap. Bullshit, he's going to be there for a while. This is the author of the Mar-a-Lago Accord, and he wants for a weaker dollar. This goes along with what I've been saying for the past several months, that I do believe that they're going to default on the dollar in order to support the bond market, in order to bring back manufacturing by keeping rates low, pegging the back end of the bond market to gold, have zero coupon on the back end, zero, and redeemability in gold. And the Genius Act will run the front end of the bond market, which will keep the wheels moving, if you will, provide the liquidity to keep the government operating in very, very, very short-term treasuries. It will back all of it. So you have zero borrowing costs on the back end. You revalue gold, which I do believe they will. You're hearing it everywhere. When I start talking about it, everyone's like, yeah, right, bullshit. Now it's everywhere, including the Federal Reserve is talking about it. James Rickard says 24,000. That might be aggressive, but if it happened, $6 trillion free and clear to the Treasury General account. We've talked about the mechanics of that before. They can pay down their debt. The devaluation of the dollar is the goal here, because now, and if you have zero interest rates on the long end of the bond market, 30-year bonds denominated in gold or redeemable in gold with zero coupons, so no interest but redeemability in gold. So the more stupid you are with your monetary policy and your fiscal irresponsibility, the higher the price of gold goes. It is the inflation gauge. You do that, you can bring back your manufacturing at very, very little cost. The devalued dollar, if what's his name, Rickards is right, it's like a 60% devaluation of the dollar. That's what Roosevelt did. Now you can sell your products across the globe, and hopefully by bringing back manufacturing into a devalued dollar, where in essence you soft default on the dollar, but you inspire demand for the bond market, you bring back manufacturing and grow your way out of this problem. But along the way, that massive chasm between rich and poor, you're going to see universal basic income for a couple of years, and people are going to starve to death because cost of living will get so expensive through this type of currency debasement.
Behind the scenes, the U.S. may be preparing for a soft default on the dollar. Analysts speculate about a future where long-term bonds are linked to gold at zero interest, while the dollar itself is deliberately weakened. Such a move would reduce America's debt burden, boost exports, and revive manufacturing, at the cost of higher living expenses. For everyday people, this means rising prices for food, housing, and energy, with only assets like gold, silver, and cryptocurrencies offering protection. The wealthy will endure, while ordinary savers risk being left behind. This is the new reality of a currency reset already underway.
And that's what you're seeing right out from under you in broad daylight right now, where 11% drop in the dollar in 7 months is crazy. So this is why those who hold assets stay rich and get richer, and those who hold their money in dollars go broke. And you know, look at it going back to 1933 over my shoulder. You have a box of $500 worth of $20 gold certificates in one, and they're $20 bills back then. Yeah, they're worth more because they're historical, but the point is, a box of $520 bills, you got your 10 grand, and you got $520 gold coins, an ounce of gold. So you have 500 ounces of gold, which back then they were the same. So again, you pull the money out of the currency. Well, those 500 ounces of gold right now, what are they worth? Almost $2 million. And what is the the $10,000 worth of currency worth? Not 2 million. The point of it is I go back as far as you want. What gold does is it retains your purchasing power, and in periods of massive currency debasement like we're seeing right now, will accelerate them. What should really wake people up is that the biggest money in the world for years has been accumulating it. Those are the central banks. They're not just the biggest money, they're the most well-informed, but now it's happening here in the United States. And there are people standing for delivery in extraordinarily large amounts of gold. And whether it's leaving COMEX or not, and a lot of it isn't the point. It's never come here. Less than 1% of contracts stood for delivery. And now in the first 3 days of the August contract, over 2,000 of them stand for delivery, 100%. There's big money that is scrambling to get stuff in hand and to hold their wealth, certainly not in dollar bills, but in assets, cryptocurrencies, physical precious metals, and any asset. Certain assets won't do as well, some will, but real estate is one of those tricky ones because of the distortion in asset prices through years of suppressed interest rates, which means all of these houses that are priced so exorbitantly, what are they really worth if we find equilibrium between rising rates and asset prices? I guess we'll find out, but that wouldn't be my favorite place to keep it. But in assets like precious metals, which haven't been allowed to accentuate, in assets like cryptocurrencies or any of these other things that should do very well in a dollar debasement scenario, I think we're walking right into their time.